1. Introduction to stock markets. What is the stock market? A stock market is a marketplace where investors buy and sell shares of publicly listed companies. It plays a crucial role in the financial system, allowing companies to raise capital by issuing stocks and providing investors with opportunities to own a stake in these companies, potentially profiting from their success. In India, the stock market is represented mainly by two major exchanges, the Bombay Stock Exchange (BSE) and the National Stock Exchange (NSE). The BSE, established in 1875, is Asia's oldest stock exchange, while the NSE, founded in 1992, is renowned for its modern electronic trading system. Both exchanges are regulated by the Securities and Exchange Board of India (SEBI), which ensures fair trading practices and protects investors' interests. Brief history of stock markets in India. The roots of the Indian stock market back to the 18th century, when securities of the East India Company were traded informally under a banyan tree in Mumbai. The formalization of trading began with the establishment of the Bombay Stock Exchange (BSE) in 1875, which is considered the oldest stock exchange in Asia. The BSE was instrumental in the early development of India's financial markets, but it was the launch of the National Stock Exchange (NSE) in 1992 that revolutionized Indian trading with electronic and automated systems, bringing in transparency and efficiency. Today, the NSE's Nifty 50 and the BSE's Sensex are the benchmark indices, representing the performance of the Indian stock market, reflecting the health of the Indian economy. Importance of stock markets in the Indian economy. The Indian stock market plays a vital role in the country's economic growth. It facilitates the flow of capital from investors to businesses, enabling companies to fund expansions, innovations, and infrastructure projects. For investors, the stock market provides a platform to participate in the growth of companies and generate wealth. Key contributions of the Indian stock market include capital formation. The stock market helps companies raise funds through initial public offerings, IPOs, and secondary offerings, supporting business growth. Wealth creation. Indian stock markets have been a powerful engine for wealth creation, with companies like Reliance Industries, TCS, and HDFC Bank delivering substantial returns to their shareholders. Economic indicators. Stock market indices like Sensex and Nifty act as barometers of economic performance, reflecting investor sentiment and the overall business environment in India. Liquidity and investment opportunities. The Indian stock market provides liquidity and varied investment opportunities, from blue chip stocks to small cap growth stocks, catering to diverse investor needs. How the Indian stock market works. Basic principles of stock markets. The Indian stock market operates on the same fundamental principles as global markets, driven by supply and demand dynamics. Companies issue stocks to raise capital, and these stocks are then traded on the open market. The price of a stock fluctuates based on factors such as company performance, investor sentiment, and broader economic conditions. Key players in the Indian market. Investors, retail and institutional investors, including mutual funds, foreign institutional investors (FIIs), and domestic institutional investors (DIIs), participate in the Indian stock market. Traders in India engage in buying and selling stocks frequently, aiming to profit from short-term price movements. Brokers. Stockbrokers act as intermediaries, executing trades on behalf of investors. Prominent brokerage firms in India include Zerodha, ICICI Direct, and HDFC Securities. Stock exchanges and their role in India. Bombay Stock Exchange (BSE). The BSE, located in Mumbai, is the oldest stock exchange in Asia and plays a significant role in India's capital markets. Its benchmark index, the Sensex, consists of 30 of the largest and most actively traded companies in India. National Stock Exchange and SE. The NSE is the largest stock exchange in India by trading volume and market capitalization. The NSE's Nifty 50 index is widely used as a benchmark for Indian equity markets, consisting of the top 50 companies across various sectors. Both exchanges facilitate trading in equities, derivatives, and debt instruments, providing a transparent and regulated environment for investors. Types of stocks traded in India. Common stock represents ownership in a company and usually grants voting rights. Preferred stock often does not provide voting rights but offers priority in dividend payments and in the event of liquidation. Sectoral stocks. Indian markets categorize stocks into sectors like pharmaceuticals, banking, FMCG, and infrastructure, allowing investors to target specific industries. 3. Understanding stocks. What is a stock? In India, stocks represent a share of ownership in a company listed on the BSE or NSE. When you buy a stock, you become a shareholder, owning a part of the company's assets and earnings. Types of stocks. Growth stocks. Stocks of companies expected to grow faster than the market average. In India, companies like Infosys and Bajaj Finance are often considered growth stocks. Value stocks that appear undervalued compared to their intrinsic value, like ITC or Coal India, which offer a mix of stability and potential for price appreciation. Dividend stocks that pay regular dividends, providing steady income to investors. For example, companies like HDFC Bank and Nestle India are known for their consistent dividend payouts. Key metrics for evaluating Indian stocks. Earnings per share (EP) is a key metric indicating a company's profitability, calculated by dividing net income by the number of outstanding shares. Price to earnings PE ratio, valuation ratio, comparing a company's current share price to its earnings per share, commonly used to assess whether a stock is over or undervalued. Dividend yield, the annual dividend payment divided by the stock price, highlighting the income generated from owning the stock. High dividend yield stocks are popular among Indian investors seeking passive income. 4. Company analysis, evaluating a stock in the Indian context. Fundamental analysis. Fundamental analysis in India involves studying a company's financial statements, management quality, market position, and growth potential. Investors often look at companies' quarterly earnings reports, sector performance, and macroeconomic factors like GDP growth and interest rates. Technical analysis. Technical analysis uses historical price data and volume patterns to forecast future price movements. Popular indicators among Indian traders include moving averages, relative strength index RSI, and Bollinger Bands. Understanding financial statements. Income statement reveals a company's revenue, expenses, and profitability over a specific period. Balance sheet provides a snapshot of a company's assets, liabilities, and shareholders' equity. Cash flow statement tracks the inflows and outflows of cash from operating, investing, and financing activities. Key ratios in Indian markets. Profitability ratios metrics like return on equity, ROE, indicate how effectively a company generates profit relative to shareholders' equity. Liquidity ratios like the current ratio measure a company's ability to meet short-term obligations. Solvency ratios assess a company's long-term financial stability, such as the debt-to-equity ratio, crucial for evaluating highly leveraged Indian companies. 5. Investment strategies in the Indian stock market. Long-term investing vs. trading. Long-term investing in India involves buying stocks and holding them for several years to benefit from compounding returns. Trading, on the other hand, focuses on capitalizing on short-term price movements and can be more speculative. Value investing, growth investing, dividend investing. Value investing investors look for undervalued stocks, such as Tata Motors or SBI, where market prices do not fully reflect the company's potential. Growth investing focuses on high-growth companies, such as Avenue Supermarts, DMart, expected to outperform the broader market. Dividend investing involves buying stocks of companies that pay regular dividends, like Hindustan Unilever, which provides steady income and stability. Risk management and diversification. Diversification is critical in the Indian stock market due to its volatility. Investors diversify their portfolios across sectors, asset classes, and market capitalizations to manage risk effectively. 6. Factors affecting stock prices in India. Economic indicators. GDP growth. India's GDP growth rate directly impacts investor confidence and stock prices, with higher growth rates generally leading to bullish markets. High inflation can impact consumer spending and corporate earnings, negatively affecting stock prices. Interest rates. The Reserve Bank of India (RBI) sets interest rates, which influence borrowing costs for companies and affect overall market sentiment. And news. In India, market sentiment is significantly influenced by news, corporate announcements, policy changes, and global market trends. Investor sentiment can drive market volatility, especially during earnings seasons and budget announcements. Global events such as geopolitical tensions, trade wars, and pandemics can significantly impact the Indian stock market due to its integration with global economies. For example, fluctuations in crude oil prices can directly affect sectors like energy, aviation, and chemicals in India. 7. Risks involved in stock investing in India. Market risk refers to the possibility of losses due to economic downturns or broad market declines, as seen during events like the COVID-19 pandemic or global financial crises. Credit risk arises when a company faces financial distress or defaults on its obligations, which can lead. I am not a SEBI registered investor or trader. This content is intended solely for educational purposes and should not be used for trading or investment decisions. Thank you for joining us, and we'll see you in the next episode.